Sitting at 30 takes you downtown for the weekly luncheon meeting of the City Club of Portland. Live weekly coverage of City Club is made possible in part by TCI and is produced through the facilities of Portland Cable Access. Now we join the City Club for this week's program.
I'm Pete Heuser, your immediate past president. Welcome to the City Club. Lloyd Anderson called in sick today, and Harriet Watson is on the road, so Nancy Hedin called me and asked me to preside today, and I reminded her that club rules said that the immediate past president was not supposed to have any duties. But my being here, you can see how successful I was in that argument. Today we're going to focus on our state and national economic futures with a distinguished panel we have here today, including Oregon State economist Tom Potiowsky, the director of the Wyss Family Foundation, Loren Wyss, and executive director of the Center for International Trade in Forest Products at the University of Washington, Bruce Lippke. Our own Dan Goldy will serve as our moderator. As you know, a week from today, we're going to host Governor John Kitzhaber's State of the State address. Now, many of you have pre-registered, and I think more than 200 have pre-registered. So if you're interested in attending the State of the State next week, make sure to make your reservations this afternoon or call in and leave a message over the weekend, because it's on a space available basis and we know it will fill up. 2 weeks from today, we're going to have the State of the City address with Governor Katz. Both of those presentations... Governor Katz. Whoa. Nancy, that's written here. If you know something that I don't know, Mayor Katz for now. So she's going to be here, and we'll all be here at the Mac Club for the next 2 weeks. Now, we have with us a new member of the staff. Suzanne, would you please stand? Suzanne Jeffries started to work on the City Club staff a week ago, and she's the club's new executive assistant. She graduated from college 6 months ago from Wheaton College in Illinois. She's a political science major. She's excited about the club and looks forward to meeting all of us. Let's welcome Suzanne to the club. Dan Goldy is doing double duty today as moderator of our panel, and member host. He'll ask the first question of our panel. And then following Dan's question, we'll open it up to City Club members in the audience. Keep your question to 30 seconds, please. For those of you who would rather have us ask the questions here, feel free to fill out one of the slips on the tables and hold it up, and somebody from the staff can come by and pick it up and bring it up to the front desk. Pardon? Oh, yes. Well, sign your name if you'd like to. You have that option. But City Club members only, please. Now, our sponsors today for our program, corporate sponsors, are Barney & Worth, Inc., Kaiser Health Systems, and Wells Fargo Bank. We're certainly very grateful for their support. Dan Goldy, our moderator today, is a consulting economist in Portland. He was the director of the Oregon Department of Economic Development from 1976 until 1979, and he's held many other economics positions both in state and federal government. He was an advisor, for example, to Lyndon Johnson on economics. He worked on the Marshall Plan in Europe on economics. I think Dan told me one time that he'd worked for one of the earlier presidents, I think Roosevelt, wasn't it? Maybe he was pulling my leg, but I thought Teddy Roosevelt. That's right. He was trying to tell me it was Franklin, but it was Teddy.
George Washington.
No. Well, as you know, Dan's been very active in the City Club. He's on the Board of Governors now. He's also active in the World Affairs Council and the Economic Roundtable of Portland. Dan will introduce the other speakers and be presiding over the rest of the meeting. Dan Goldy.
Thank you, Pete. Welcome all of you to our annual economic forecast session. I want to say that forecasting is always a hazardous occupation, and some of our friends in the audience believe that it cannot be done accurately, if at all. I was at a cocktail party earlier this week, and I was told that economists were put on the earth to make astrologists look good. Now, let me introduce the three brave souls who have agreed to join me in peering into the crystal ball and tell us what they foresee for the year 2000, the first year, I think, maybe, of the new millennium. There's some dispute about that. First to speak will be Bruce Lippke at the far end of the table. Bruce, as Pete said, is director of Centrifor at the University of Washington, and he's associate dean of the College of Forest Resources. Now, Centrifor, for those of you who have not heard about it, provides an interdisciplinary program of research, outreach, and teaching focused on international trade of forest products and its importance to the Pacific Northwest and the nation, as well as the economic impacts of policies and supply constraints. I have found that Centrifor is probably the best informed group about the status of the economies around the world. And I wanted particularly to have Bruce here today because what happens to the economies around the world is a big factor in what's going to happen to our own economy. Bruce was formerly president of Wharton Econometrics in Philadelphia, and for 12 years was manager of marketing and economic research at Weyerhaeuser. He was a co-founder of the National Business Economics Issues Council, a past chairman of the Conference of Business Economists, a member of the Council of Economic Advisors under 5 governors for the state of Washington, and is a member of the National Association of Business Economists. He is going to address us on the outlook for overseas economies and their likely impact on the U.S. economy and the state economy. Our second panelist is Tom Potiowsky, who is Oregon State economist. He is on leave from Portland State University faculty, where he was professor and chair of the economics department. Tom received his bachelor's degree in economics from Ohio University and his PhD from the University of Colorado. He has written academic papers, consulted for local businesses, and helped develop educational programs in Poland and Hungary. Tom is also on the board of directors of the Oregon Council on Economic Education. Tom is going to address us on the outlook for Oregon's economy in the context of the national economic forecast. Remember, it is Tom's forecast now that determines whether there is a kicker check in the mail when the next biennium budget period ends. Our third panelist, Loren Wyss, has been involved in this exercise as long as I have, which to some of you might seem like forever. Loren is president of the Wyss Family Foundation and has been in the investment business since 1960 as a stockbroker, analyst, money manager, and mutual fund executive. He was a founding investor and led the investment policy team at Columbia Management Company from 1967 to 1982, also serving as portfolio manager of the Columbia Growth Fund. Since then, he has been an advisor to institutional investors, foundations, and corporations, both here and in the UK. For 8 years in the 1970s and 80s, he broadcast a daily radio program about economics and the market on regional radio stations. He served as a member of the Board of Higher Education, and most of you remember him as chairman of the TriMet Board. He holds BA and MBA degrees from Harvard, but we won't hold that against you, Loren. Loren will give us his fearless forecast of what will happen to stocks and bonds this year and what effect the performance of the financial markets might have on the economy. Now, I'm going to do my board host function of asking questions before they speak. As a matter of fact, I gave them these questions in advance to focus today's discussion. I pose 4 questions to the panelists. First, will the Federal Reserve Board continue to raise interest rates until the economy turns down? Those of you who had a chance to read today's paper know that Alan Greenspan made a speech last night in which it became from 99% to 100% certain that the Fed's going to raise rates in February. The question is, will they continue to raise rates until the economy turns down? And once turned down, will it gather momentum, or will the gross domestic product rate be stabilized at a predetermined level? Can it be? In brief, the question is, can the Federal Reserve Board fine-tune the economy? The second question was, the Fed assumes, that's the Federal Reserve Board, assumes that a vigorous Asian recovery is underway and that a strong economic growth is occurring in Europe, thus putting pressure on supplies and prices. The question is, how durable is the Asian recovery absent major reforms, and are the European economies still in a recovery mode, or are there signs that they could be stalling again? The third question, normally the economy drives the financial markets. Recently appears to be the reverse, with consumers spending their stock market winnings. If there is indeed a bubble and it should burst, what will be the impact on the economy? And finally, we have seen a strong upsurge in high-tech industries, in part fueled by Y2K-related buying and in part the Asian recovery. With Y2K behind us, will we see a decline, a pause, or no discernible effect on orders and employment growth in the high-tech industries? And of course, Tom, this is a very big question that overhangs the Oregon economy. Now, you, the members of the City Club, can follow up on these questions or ask any others that occur to you. After the initial presentations, we will take a few minutes to raise questions with each other, after which we will take questions from City Club members. Please keep your questions short, and please leave the speeches to the panelists. Okay, Bruce Lippke.
Thank you, Dan. Well, while it's a pleasure to be here, economists are known for dismal stories, and especially in boom times, so the story may not be as pleasurable as the opportunity. It's really amazing what a difference a decade can make. It was only 10 years ago or 12 years ago I came back from the East Coast and was giving speeches, and the number one thing I talked about in every speech was the Japanese bubble that had raised their asset values to 55% of the total world's capital markets from under 20% just a few years before that. The typical forecast we talked about was there had to be an adjustment or a correction followed by a recovery, but none of us at that time would forecast that the Japanese economy would stay flat with no growth for almost a decade, with the debt overhang problems just being pushed forward 1 year at a time. Now, why is this important today? Well, because today we're trapped in that Asian bubble. The U.S. has a P/E ratio problem. The P/E ratio for many companies is out of sight, suggesting no more asset growth over a long period of time, perhaps. But let me set the record straight. I'm from the university. We don't have a P/E problem. We do have a 601 problem, a 495 problem, and a 695 problem, which are the 3 initiatives that have been passed to control expenditures. And that, of course, took away any bubble that we had coming our direction. So in spite of the U.S. enjoying the longest peacetime expansion of the century, and the phenomenon that the world's economies are becoming more free, which in some long-term context almost certainly means that we'll have faster global growth, the U.S. economy is in a much more precarious position than it might otherwise appear. Now, to a large degree, our extended boom has been a result of the crony capitalism in Asia making too many bad investments, which contributed to their bust, along with the Japanese deflation. Money fled to the U.S., and the decline in the Asian economies produced slack capacities as well as deflated currencies that killed any threat of inflation in consumer goods in our extended growth boom. By one estimate, the U.S. is using 72% of the net global savings. The fact that our investments have been booming has certainly got its good side as it's increased capacity and efficiency. But our debt structure has soared with it, and corporate defaults are as high as they were in the last recession, even though the economy is in an extended boom. The private sector's financial deficit has risen to almost 5% of GDP, and that's an unprecedented increase since it wasn't much over 1% in 50 years. We didn't have to convert the federal deficit to a private deficit, but we have. The inflation has been in assets instead of goods. The debt is invested in this bubble economy. Household debt has increased from 80% of disposable income to 100% in just a few years. Financial sector debt has ballooned from 45% of GDP to over 80%. Now, yes, the boom could go on and on. Even Wall Street economists have underforecast the economy consistently over the last 6 years, with an average growth forecast of 3.4% being 50% higher than their actual forecasts. But as Greenspan said, history tells us that sharp reversals in confidence occur abruptly, most often with little advance notice. And he added that these reversals can be self-reinforcing processes that can compress sizable adjustments into a very short period. So much for stability, Dan. So what scenario should we be concerned with that might unravel this boom? That such things as that e-commerce stocks have been bid up to 50 to 100% in just a couple of months. You know, we used to talk about efficient market theory. I know of no special events that would cause a big chunk of the market to be revalued that much in just a few months. So what might bring this bubble to an end? Well, if you start with inflation, it's still in check. The National Federation of Independent Business Survey, which is most of the economy, shows only 5% of their firms raise prices net of the reductions. And wages are also not escalating. Interest rates have increased, and it has been a disaster year for bonds, but they still aren't high enough to starve out much of the economy. The rest of the world is getting back on its economic track. Other than Japan, the Asian recessions were all what we would call V-shaped. They were sharp, and the recoveries have been fairly strong. They took at least enough of the reform medicine to come back fast. Their debt restructuring is certainly not complete and may cause a few more up and down swings than they had in the past. But the economies are more open. There don't seem to be many doubts that they are, in fact, worth renewed investments. Their capital outflows are reversing, and their export of savings to the U.S. and the rest of the world is in a declining state. The slack in the global capacity will begin to disappear, but not abruptly. Our import prices have already turned to positive changes after several years of deflationary declining prices. So either interest rates are going to have to go up to compete for capital, or the market has to already slow down so that they don't have to go up. And U.S. profits begin to take a hit, so those PEs start to come down. And with all of that consumption that has been supported by this asset inflation bubble, the economy comes to a grinding halt, and not as smoothly as people would like. The growth rates of the high-tech companies would tumble under conditions like this, and the pyramid game of investing for growth and not for earnings would have to take a breather. Now, that's the kind of scenario we should be worrying about, and whether and how we can avoid it. I think Greenspan is already trapped. If he pricks the bubble, he gets blamed for the collapse. If he doesn't, it just comes later. Europe isn't suffering from crony capitalism, but it certainly has not lived up to the expectation of a unified currency, or at least not so far. The welfare state structure continues to apply a healthy drag on their economies. Even so, Europe may be poised for a round of consolidations that could produce a stock market boom and real competition for our use of the world's savings. Latin America and other developing countries have been shedding crony capitalism, and more countries than have regressed. They currently represent only about 8% of the world's stock market, compared to 45% of the world output, 70% of the land area, and 85% of the world's population, and 99% of the projected growth in the world labor force over the next several decades. That's a lot of opportunity for stock market development, for competition to our new pyramid economy. The global economy continues to expand. The foreign domestic investment growth over the last few years has been like 12% rate comparative to about 7% for world trade. Foreign investors used to be the vehicle to get around trade barriers, so you could sell in foreign countries. Now it's the opportunity for productivity gains and comparative advantage to invest overseas. The result has been declining costs for many products and increased global savings and reinvestment. Now, we in the Northwest have learned long ago that we depend on trade and global markets, largely because of our location. Much of our growth over the last decade was derived from exports. The Asian economic crisis cut exports substantially, reducing the income to agriculture and the forest sector tremendously. Forest exports to Asia were cut in half in 1997 and 1998. Now, lowering tariffs, which was supposed to be the WTO agenda, would increase incomes around the world and make the countries able to afford higher worker and environmental standards. It would also have increased value-added exports from the Pacific Northwest. That's what got trashed in the WTO meeting. What the WTO has done is to force countries like the U.S. to rethink their policies, even environmental policies, if they're discriminatory between countries. And I have to ask, is that bad? And speaking about current policies, we in the Northwest are the victims as well as the beneficiaries of some pretty major environmental policy changes. The protection of the spotted owl, a benefit to some at least, has resulted in a 25% loss in forest product market shares in most of our international markets. Europe had no lumber market share in Japan in 1993, but has 20% of that market today, while our share fell from about 40% to 15% and is still declining. And while we were the leaders in opening Asian markets to secondary manufactured goods, things like doors, windows, and prefab homes, with the Canadian countervailing duty and quota system on lumber, which tends to produce a two-tier price structure with higher prices in the U.S. than Canada, we're rapidly losing our share of manufacturing exports in Asia to the Canadians. We no longer are as cost competitive as we were, and this is really going to hurt once the U.S. market weakens. The Japanese have discovered through our supply constraints that there are more reliable suppliers around the world, not just Europe and Canada, but New Zealand, Chile, Australia, Brazil, and even Russia. In Washington State, we're about to implement new salmon protection rules, which will put in reserves at least another 8% of the private forest land. Now, that's a much bigger impact on private lands than the protection required for the spotted owl. Some small owners might find it 80% of their land if they find their lands in a riparian zone. More mills will have to close. The Asian markets will be forced to buy more from our competitors. And the gap between rural and urban incomes in timber communities, which has already increased by 70% over the last couple decades, will widen some more. Even so, forestry is way ahead of agriculture and the urban centers and the water managers in dealing with the salmon issues. So the full economic impacts of the salmon preservation efforts is going to take many more years. The votes for regulatory solutions may be coming from the urban centers, but the rural communities are so far the ones paying for it. Now, to try to summarize that in the forecast, it's pretty simple. The U.S. economy can probably coast through most of 2000 on the momentum it has. Interest rates will go up some more. The year 2001 could well be the year our economy runs out of steam. But at the same time, the rest of the world is in better shape to survive a U.S. downturn than it was a couple of years ago, and export markets that are important to our region will be recovering. Unfortunately, for many products, we in the Northwest are no longer very competitive. The trade-weighted dollar is as strong as it was in the early 70s. That's not well known to many people, but the dollar is very strong, and it's making us very uncompetitive in international markets. And it seems to me the new economy is likely to go through its first major shakeout as a consequence of these things. But then again, it may not. That's the risk of forecasting.
Well, it's a pleasure being in front of this group. The last time I was here was about 10 years ago, I think. And also want to ask you, those of you that have been calling the office saying that your kicker check was too small compared to 2 years ago, my predecessor, Paul Warner, did such an excellent job of forecasting revenues this time, it barely kicked. And that's one of the reasons your checks are so small. So call him, call me in 2 years. So what I'd like to do is just talk a little bit about the national economy and international, because for better or for worse, here in Oregon, although we like to think of ourselves as being quite independent, if Greenspan sneezes, we do catch a cold, and we will also catch a financial Asian flu too, if that should happen. So first of all, the U.S. economy, if it makes it through into February, will be the longest expansion on record, bar none. Peacetime, wartime, since records were kept in 1854. Now, what does this remarkable economy look like? Well, we have GDP growth in the third quarter of '99 was at 5.7% annualized rate. It's been above 4% both in '97 and '98. And our best guess of long-term growth is around 3%, or maybe 2.7% only. So it's very strong growth. Inflation, the CPI for '99, the information just came out today, is running at 2.7%. It's up just a little bit. But the core rate, if you take out food and energy prices, is only up 1.9%. And that's the lowest in 30 years. Unemployment, also the lowest in 30 years, at 4.2% for '99. In the month of December, it stands at 4.1%. Employment gains have been strong. And on top of all this, productivity has been the strongest we've seen. Double the rates we saw in the 1980s and triple the rates in the 1970s. Now, productivity has really been one of the big stories for this economy, and I'm going to emphasize that in just my comments in just a moment. It's really caused great efficiencies in our economy, allowing both skilled and unskilled labor to become much more productive. We now have workers in offices that have no concept of how to use a bottle of whiteout. And in fast food outlet places, the workers that are at cash registers really don't need a concept of decimal points, but they do have to distinguish between the picture of a Big Mac and a bag of fries. So, what we have now is, through most of the 1990s, the U.S. economy was the growth engine in the world. In fact, for 1998, it's estimated that the U.S. economy accounted for 48% of total world growth by itself. In February, this expansion then is going to reach our record books, and it all seems like it definitely will do so. Now, every expansion since the Great Depression has ended with a run-up of inflation followed by a policy reaction to slow down the economy. Now, so far, how have we avoided this? Because we're at the longest expansion we've ever seen so far, and can we keep dodging this inflation bullet? Well, with the U.S. economy alone in the world as the place for an engine of growth, what happened basically is money just flowed into our economy. There wasn't really no place else to put it. This raised the value of the U.S. dollar. It deepened our trade deficit, which kept some of the countries going, at least for their export sectors. And U.S. firms face very stiff competition from foreign firms. Also, on the labor side, labor markets are getting tight. Wage demand started going up. So what do you do as a firm? You can't raise prices because you have stiff foreign competition. You have your costs from your labor side starting to go up. You're going to lose workers if you don't try to pass on some higher wages to them. Your only other place to keep in place is to lower your non-labor costs, and this is investing in capital. And the money was flowing in, capital is cheap, interest rates are low. Wonderful situation to have exactly that and cause this great productivity that then allows firms to pass on some higher wages and not have to raise their prices. And when inflation is relatively low, you can have relatively low wage increases, but that still would represent real income increases for workers. And so it's a wonderful environment to keep. But can it continue to keep going? Well, Paul Volcker, past chair of the Board of Governors for the Federal Reserve, he likened central bankers to Puritan ministers. He said that they have this uneasy feeling that at any time and at any place there's somebody that's happy. So the Federal Reserve now is poised to take a preemptive strike against what they see as a possible inflationary environment. But what we want to see now is, well, how exactly can Greenspan, who's touting the new economy and did so in a speech yesterday to the Economics Club of New York, and at the same time worry about inflation? Well, the worry here is coming because, as Bruce had mentioned, the non-Japan Asian countries and also in Europe, Latin America, we're starting to see some revival of global markets. Are doing much better. And with that, we're starting to see some commodity prices rise, and especially we've seen energy prices going up in those commodity prices. With that happening, our protectors against inflation, which has been foreign competition and productivity, could be at risk. Just as we've seen the double-digit increases in the stock market over the past 5 years, the Federal Reserve, in my opinion, believes that these productivity gains we've seen recently are somewhat of an aberration in the long history of things. They are not a long-run trend. So with that, the Fed is very uncertain, I believe, in both the outlook for the stock market and for productivity. And if, and this is a very big if the global market economies are truly recovering and that recovery is underway, the Fed then, I believe, sees inflation as a real possible threat. So the possible expansion in the U.S. could come to an end because of two reasons. One is the traditional reason. What we could see is the Fed decides, Greenspan says, well, you know, maybe that new economy idea is truly there and inflation is really licked. And instead, inflation really does heat up. Federal Reserve policy does take a number of quarters before it really impacts the economy. And if the Fed is slow to react, inflation heats up, then the Fed has to overreact, and then that would cause our economy to go into recession. And I would agree with Bruce that that's probably 2001. We could have a new, though, reason for the stopping of this expansion, and this would be a post-World War II new reason for the U.S. economy. In that inflation stays subdued, but we have a major stock market correction. Now, we do have an international example of a sense of a speculative bubble being burst, and that's Japan. And that would be, I believe, very devastating for our economy. So what does the National Economic Outlook have to say about our Oregon outlook? Well, in 1998 and 99, Oregon truly felt its international ties. As Japan was faltering in the 1990s and started even a steeper decline with its financial crisis in 97, its major trading partners in the Asian arena really started to decline. And across the Pacific, here in Oregon, we joined the pack and declined also. Before the Asian financial crisis happened, 64% of all merchandise trade for Oregon was with Asian countries. And that's the highest among all Western states. And I think, if you think about that, that's even higher than the state of Washington with its big ticket planes from Boeing. So we were disproportionately affected by this Asian downturn. And it went across the manufacturing sector, both high-tech, lumber and wood, and also affected agriculture. In 1998, in 99, these were the first years since 1985 that we had employment growth in Oregon that was below the employment growth for the U.S. average. So that was over a 15-year run we had where we were growing stronger than the U.S. As we ended 1999, global markets did start to improve. Asian countries, excluding Japan, seem to be in a full recovery phase. Even Japan has seen some growth, even though just in this recent third quarter, there was some faltering in their economy. As these global markets tend to start to recover, our trading partners also have changed in importance for our state. Japan, for the longest time, was far and above our largest export market. Now they're number 3. Our largest export market is Korea, followed by Canada. High tech has started to rebound from, I believe, the global market recoveries and the continued domestic demand we have in the U.S. Lumber and wood and agriculture, still Japan is their major export market. They're still struggling a little bit, although starting to improve somewhat. Commodity prices, both lumber and wood and agriculture, are starting to firm up a little bit. The latest interesting export market that we have for the Oregon economy, and this might be a result of NAFTA finally having some effect, is the transportation manufacturing sector. Amazing growth has happened there, with a huge amount of transportation equipment going both to Canada and to Mexico. So let me give you a quick roundup for the Oregon economy. We expect the Oregon economy to grow around 2% employment growth for 2000 and 2001. High tech's going to lead manufacturing, and what we'll probably see is construction slowing down a little bit more as interest rates start to rise up. And we have every expectation, it's also in our forecast, of an increase, at least for the February meeting for the Fed. So recent history, though, clouds our perceptions. And what we're going to see is this coming year is really a year of normal growth for Oregon, but we may view it as a year of slow growth. We're going to start to improve over what we did in 98 and 99. But this normal growth is going to be around 2%, not the mid-90s of plus 4% employment growth. So with that in mind, we're not calling a recession. We think we're going to have some normal growth occurring. And our faith is in the stock market continuing and in the Greenspan being able to engineer that nice soft landing he's been talking about. Thank you.
Thank you. Thank you, Tom, for putting us on course there. The stock market is then responsible for how the economy does. I hope that you expect that the stock market will have a bad year and therefore the Oregon economy is only going to grow about 1%, and that will be the estimate you send to the legislature. It's good to be back here today. I think this is about the 5th year that I've been in front of you. And I could get us all back on the time track by doing what I should have been doing the last 5 years, and that was simply standing up, saying buy stocks, and sit down. Over the last 5 years since I've been here, the Dow Jones has averaged a 25% gain each year. The S&P has been up about 20% each year. During the 1990s, the market has gone from 2,500 to almost 12,000 today. So I've cluttered up the picture by telling you how the money was flowing on self-directed 401k retirement plans, that people were entranced with mutual funds and were directing their own money into it, and that there was a new technology that was leading more and more of the American savings back into the stock market. I shouldn't have talked about any of those things. I should have simply told you to buy stocks, and I apologize. The second thing I have to tell you today is that I need to apologize for my projections a year ago. And this flies somewhat in the face of what both Bruce and Tom have told you, because unbeknownst to most of you sitting here, unless you are investors, 1999 turned out to be a bear market in the stock market, in spite of what the averages showed. 54% of all of the stocks on the New York Stock Exchange were down this last year. 56% of the Russell 2000, which is a much broader list of stocks, were down on the year. And 57% of the S&P was down on the year. The median stock was off 3.4% during 1999. And let me see, 37 stocks out of the 500 in the S&P accounted for all of the gain. That means that 460 stocks were down, 463 stocks, and 37 stocks were up. So I would call that a bear market, and I would tell you that the so-called bubble in the stock market is a very narrow bubble, that there are many stocks that are selling at incredible price-earnings ratios. The average tech stock is selling at 50 times earnings, which is about 2.5 times what the average stock is selling for. It is selling for 11 times book value, which is about 3.5 times what the average stock is selling for. But the average stock on the market today is selling for very acceptable rates on a fundamental basis, considering the values of most stocks during the 1980s and the early part of the 1990s. This bubble that we're talking about is a very narrow bubble indeed. There were other variations in the way performance went this last year. The big stocks did better than the small stocks. The growth stocks did better than the value stocks. But in general, if you didn't own a load of technology stocks, you didn't do as well as the averages, and you might have had less money value in the market at the end of the year as you had at the beginning. Out of the 13 major groups, only 3 groups were up on the year, including technology. 9 groups were down. 1 group was even. So I think that even though this is the second year in a row that the tech stocks have gained 73 or 74%, I think that we have to be skeptical about the generally perceived notion that the stock market is so high that is teetering on the edge, as the Japanese market was, of plunging 70% in value over the next 2 or 3 years. I think that's unlikely to occur. It's also unlikely, however, that the leadership that we have seen, this technology leadership, will go on forever because the market tends to rotate in its leadership. In fact, up until the last 6 years, it wasn't growth stocks that led, it was value stocks. If you go back 25 years, for 19 years, value stocks beat growth stocks all hollow. Value portfolios were 45% of growth stocks for the first 19 years of the last 25, and only in the last 6 years have growth stocks been the darlings of the market. I would come to the conclusion from that is that things can change again. I'd also like to have, if we had time for it here, I'd like to have a little contest to see what you think the average return has been from the stock market over the last 100 years or the last 200 years in America. I'll give it away. I'll tell you that in the 19th century, the average stock returned 6.2%. For the 100 years from 1800 to 1900. And in the technology-rich 20th century, with all the science inventions, we've ramped up that return from 6.2% to 6.7%. So over the last 200 years, the average return for the stock market has been 6.4.5%. That's not enough to sweep you away and think that you're going to get exceedingly rich by expecting the 20-25% returns we've seen the last few years. So I would warn you that there are likely to be changes in the future. How about the next decade? Well, decade to decade returns also have been all over the map. In the 1930s, the average stock returned 0% year to year. It had some trouble at the beginning, of course, you remember. In the 1940s, the average stock returned 9%. In the average 50s, 19%. In the 1960s, 8%. The 1970s, 6%. And the 1980s back up to 18%. I'm not bragging about these things. I'm just telling you that there's a tremendous change from year to year. And so people who are projecting that we are going to have either an extension of what we've been going through or a tremendous change don't have history on their side. There's no way telling from the recent past what the immediate future is likely to be. So what caused 1999 then to be such a terrific year? I think that my actual real economist colleagues here, I'm not one, have given you some of these reasons. The first was that the Fed tightened, and we would have all said that if the Fed was going to tighten 2 or 3 times, the stock market would have a very difficult time, because in the past it always did. Most recently in 1987 and 1994, the Fed tightened 2 or 3 times, and the market tanked each time. If you had told us this a year ago that the Fed was going to raise rates a couple of times, we would have said very bad year for the stock market. The Fed raised rates 3 times, and the market is up 25% on the year, or those few stocks that I told you about earlier are up. So that was a big surprise. I think people saw the economy able to forge ahead even with rates up, and that, while it scared people and the market went down during the late spring and the early summer, it also gave them confidence to come roaring back with their savings, so that, as Bruce mentioned, during the month of November and December, we saw some stocks like Yahoo, wisely named, went from 250 to 500 in less than 30 days. It's back off to 360. It's a terrible reaction. The other thing that happened during the year that surprised people, I think, was that many of the people that we've trusted in the past to be sensible about advising us on investments went crazy. And this ranges from Louis Rukeyser, who is always crazy, to Peter Drucker, who is usually very sensible. These people who in the past used very conservative methods for evaluating stocks and warning people about how to invest said, this is a new era. I mean, this is an information era. We're going to go through a period in which companies and earnings go up very much more rapidly than they have in the recent past. We're not at all sure that the old fundamentals work. And so people began to believe that the way to make money was, of course, buy from the new high list. And that's been working. In fact, my favorite story this year comes from Robert Kirby, who is a 75-year-old former chairman of Capital Guardian Trust in Los Angeles, one of the great men of American investing. His wife asked him a couple of years ago if he thought it would be a good idea if she joined an investment club in Pasadena. And he said, I think it would be a good idea, dear. She didn't know anything about investing. After 2 months, she came back and she said, Robert, dear, I'm going to quit the investment club. And he said, why? And she said, it's very boring. I'm not interested in that. And he said, do you think that they would let me go in your place? And she said, oh, I don't think so. You're a man. And secondly, you're a professional, and they don't like either of those things in the club. And he said, no, I promised to go and sit quietly. And so she said, I'll take it up with them. She did, and they said, all right. So he came to the meetings, and he's been there now for 9 months. And he reported in November that they have 2 rules. One is if a stock has tripled during the last 12 months, it's on the buy list. And secondly, if a stock falls below the cost, sell it. And he said they were up 38% last year. Well, I would say that as we look into this coming year, we do need to believe that some of this tech volatility that we've seen and these tremendous mania does need to be readjusted. And I would think that we will come into that during the first part of the year. I would think, though, that you have to say that the American investors have learned to invest in just one way, and that is to buy stocks that buy companies that seem to have good products no matter what the price, buy them when they're going up. When they stop going up or start to go down, pull back a little bit and wait until they start going up again and buy them once more. And I'm sure that that is the pattern that will reassert itself during this year. I would say, though, that we are going to have some periods during this year in which people question what the actual impact of the Internet will be on American business and on international business altogether. The Internet is simply a way of exchanging information, and as an industry, it's not really very important. The really important thing about the Internet is how it's integrated into American industry, how American industry uses the Internet and e-commerce to lower costs, expose themselves to much more competition within various industries, and potentially to increase margins. But there will be many companies whose margins will be badly impacted as all prices are posted publicly. Now, when you post all prices publicly, it will tend to bring margins down. It will compress margins, and there will begin to be many obvious losers in this new e-commerce market. And during the year 2000, I think that will start to show up, which will probably bring some bear raids on some great companies that don't seem to be able to get with it with the new e-commerce market. So watch out for that during the year, in which for the first time e-commerce and the Internet show their Janus evil face. It's going to be very upsetting to investors when they realize that perhaps the market leadership of the next few years will depend upon who succeeds and who doesn't in that. So let me finally repeat that for this year there's going to be a lot of volatility. I will tell you what I believe the market's going to do, but unfortunately I mentioned it to Abby Joseph Cohen the other day and she's blabbed it everywhere as usual. And so you know, it's a joke, I don't know Abby Joseph Cohen. This year will start slowly, and then sometime during the second or third quarter, as rates don't seem to have a great impact on the market, I would think that we'd have another surge upward in the market, probably establishing the high for the year. Another 2 increases in rates, which are probably unnecessary, will bite into the profitability of many American companies, and I would expect that the year will not end as happily as it's begun. Probably a 10% up market, mostly led by those tech stocks again, or a group of other tech stocks. And before the year ends, there will be many more questions about the year 2001. I agree with my colleagues on that. But on the whole, maybe I should just forget it and tell you to buy stocks. Thank you.
Well, thank you very much. Thanks. I feel like Scrooge up here, having to clink a glass to get them to stop because it's so interesting what they're saying. I hate to turn it off. Time is such that I think we're going to forego the questions up here of one another. I'm going to just exert the prerogative of a chair, though, and ask one question of them, and then throw it open to you people. So start lining up at the microphone now if you have questions. My question is the one I started with. I think the biggest thing that biggest problem overhanging the economy this year is whether the Fed will overdo it, tighten too much, particularly given the fact that there's no discernible inflation in the United States. And we seem to be able to keep inflation down by importing the surpluses from abroad. My question is this: if the Fed tightens and continues to tighten until the economy turns down, does anybody on the panel think that they can level it off at some predetermined GDP rate of growth without it continuing to go down? Panelists?
The first no comes from me. With the asset bubble that we have, regardless of how narrow it is, it seems to me that it's next to impossible to smooth that out. That is to say, if you look at what's driving consumption, an awful lot of it today is being driven by this asset bubble. It's the asset inflation going into consumption. And all the Fed can do is to pull on a string. It can raise interest rates, slow down the interest-sensitive sectors. The minute the consumption slows down, why, it's not going to be something they can easily manage.
Tom?
Well, the nice thing about the U.S. economy right now, it's in an environment where inflation hasn't really gone up yet. The Fed, looking to be preemptive, I believe, about inflation, most likely will raise rates up this February 1st or 2nd, I think, is their meeting. But it looks like they'll probably be more on the 25 basis points rather than, I think, the 50 basis points the markets were thinking about, given the speech Greenspan gave yesterday. Also, we have, and even with Y2K, where we believe there's going to be a huge run-up of inventories in anticipation of it, we still are at an all-time low for an inventory to sales ratio. So if there is a little bit of a slowdown in the economy, the ability to firms having to cut production to move out that extra inventory isn't really going to be there. So if there is any sort of slowdown, I think it would be something rather quick. Now, if on top of it, you also have the speculative bubble in the stock market doing a huge major correction, then all bets are off.
Loren?
Well, the last two times that we had an international slowdown, or even a national slowdown, the Fed simply flooded the economy with cheap money. And that was with the perception that there was a possibility of international problems becoming serious national ones. If you have the domestic economy itself very weak, it will be much harder to do that, and they haven't shown that they have any tools that work that way. So I would think that if they start a downturn, we will go through at least a cyclical recession, probably only an average one.
Well, I see no long line over here at the microphone. I take it you're all overawed by the incredible knowledge and abilities of the panelists and are fearful of asking them any more questions. Oh, here we got some brave souls coming up to the microphone.
Matthias Kemeny, City Club member. How much more will the interest rates go up, and for how long?
Anybody want to?
This is a good one, because this is a good forecaster question. Given the situation of global markets today, also the situation of where the inflation rate is at, the stance of the Federal Reserve, I believe that our rates that are slightly going up today will continue to do so unless they decline or stay the same. I think what we're looking at, actually, the national service that we use, which is Standard & Poor's DRI, is looking at, if we want to use something like, like mortgage rates as an example, we're looking at probably 8.5% before settling down towards the end of 2000 and basically being around that level in 2001.
I'm skeptical that we will have that much increase. I think that it'll become increasingly clear as the year goes on that because of the globalization of markets and the ability of other markets to play into ours and that unused capacity that Bruce mentioned in his comments, that inflation doesn't come back cyclically. And I don't think that the Fed will continue to raise rates just to be raising rates if inflation doesn't begin to show.
Don't you think, though, that the Fed will keep raising rates until the domestic GDP rate goes down? That's what they have announced that they want to do, is slow the U.S. economy. They think it's roaring along. And if they keep raising rates until it goes down, my question is, once it goes down, can they then turn it back up again?
No, we got through that question. This was
I agree, but the point is, Loren, if they decide they want to turn the economy down, the fact that there's no inflation now on the horizon, that we can see, and none later, why wouldn't they keep going until it's too late?
Why would they? Why would they consciously put the economy into great stress if it doesn't seem to be necessary to do so?
But isn't that what they're doing now?
The economy so far seems to be able to accept it, but we're talking about if we go up twice more or 3 times more or 4 times more. I say they're about done.
Dan, we still have rates, interest rates that are below where they were in 94, 95, and those are pretty good years.
I usually hand my questions in without signing the paper. Mr. Lippke, you said something about the environment concerns, and I think of Tom Friedman's article, Senseless in Seattle. Could you all kind of comment on that sort of issue, the WTO, and so forth?
Well, coming from a research perspective, I treated the WTO as the most successful disinformation campaign I'd ever seen in my life. And I hope never to see another one, and the thing that scares me the most is what the next one will look like. All the analysis we've done would suggest that lower tariffs, freer trade would improve incomes, it would improve the efficiency and performance of companies, all of which in fact has positive environmental aspects to it. The claim by the protesters that our sovereignty was at stake is a total fraud. The fact is that what they said is that you can't discriminate when you're playing around with environmental policies. That's all that the WTO said. And it was pretty easy to fix that if we just addressed the issue directly, which we are. And the fact that what they said is we'd like to connect labor standards and environmental standards so that the WTO will enforce it because our international labor organizations don't have an enforcement mechanism. That, of course, is an invasion on the sovereignty of the 100 and some developing countries who could see through that quickly. And furthermore, our administration was catering to the protesters, so we helped to destroy the event as far as the positive effects that could have come out of the WTO.
This is the final question. Gus?
I guess I'm addressing a comment to you and in part also to the rest of the panel. The discussion this noon has been entirely about monetary policy, raising rates, lowering rates, and such. Not a word has been said about the fact that the U.S. Treasury can exercise fiscal policy in a very powerful way. It hasn't done it recently, but it's very possible to do it. And Dan, if you're worried about the downturn, the tools are available to revive the economy at any particular point by a vigorous application of fiscal policy. I'm a bit disappointed that no